Hello everybody, this is AK. I'm back. So my video last night seemed to have caused quite a bit of concern among viewers. And if you have yet to watch it, go watch it first and then come back to this video. Or you might feel a bit lost as I go on with this video. Okay. If you watched last night's video already and if you're still here, okay, let's continue. Okay, although some felt that I was being too negative in last night's video, I thought I was just being pragmatic. So an example of a comment from a viewer was that to last night's video, the response was, "This is a very negative view. I personally do not believe a repeat of 2008 is happening, or even anywhere near that magnitude. The Fed has a dual mandate. If there is really a credit crisis, unemployment spikes, the Fed will drop the interest rate fast." And to that, I said, we know the famous last words, "This time it is different." Well, this time it could be different because if inflation remains stubbornly high as the economy goes into a recession, the Fed would be stuck between a rock and a hard place. This wasn't the case in 2008 when asset prices were in a free fall. So rather than think I have a very negative view, it could be better to err on the side of caution. Okay, that was my response. And like I said, I thought I was just being pragmatic, even though some thought I was being too negative. However, after coming across an article by Channel News Asia and also an opinion piece on YouTube, I think I might actually have been overly sanguine. So what do I mean? I mean that things could get a lot worse than what I said could happen. Yes. So in an article by Channel News Asia, I found something that I failed to consider in last night's video. And I will read you the segment of the article which rang alarm bells in my head. Okay? Here goes. The Bank of Japan has held steadfast to ultra-easy monetary policy, but a tighter stance is on the cards. And the risks are rising of a sharp unwind from an era of Japanese cash pumping into everything from US tech stocks to high-yielding emerging market currencies. BOJ is likely to hike its policy rate in January. It notes that Japanese investors who have long sought better investment yields elsewhere own around $1 trillion of US bonds. They are big holders of European and Australian debt. Okay, now what this means is that if the Japanese central bank starts unwinding, right, cash pumping, and interest rate starts going up in Japan, there is less incentive for Japanese investors to hold European and Australian debt and to invest in higher yielding emerging market currencies and US tech stocks. That's what it means. Okay, let's continue with the article. Japanese selling of treasuries could further push up yields. Okay, that makes sense because they're increasing interest rates here, already at their highest since the global financial crisis, which means interest rates could go even higher from here because of what the Japanese might do in January next year, and that is to sell treasuries and push up interest rates in Japan. That could hurt equities, which tend to perform worse when investors expect higher returns from low-risk government bonds, and in this case is the Japanese government bonds or JGBs. Okay, so that's something I did not consider in last night's video. And if this really happens in January or sometime next year, interest rates in Japan goes higher. This is going to affect risk assets everywhere else in the world because there's been a lot of carry trade where investors borrow cheap Japanese yen and invest elsewhere for higher returns. Right? So you can see the repricing of risk assets elsewhere in the world could be impacted as well because of what's happening in Japan. or what could happen in Japan next year. That's the first thing. And I'll leave a link to this article by Channel News Asia in the description box below, so you can read the full article, because there's only a section of the article in case you are interested, right? And also, some viewers might remember that I said in last night's video that if risk-free rate stays higher for longer, a lot of risk assets, in fact all risk assets, would have to be repriced lower. This will automatically affect gearing level for REITs, for example, because if they were to be assets repriced lower, without having to borrow a single cent more, gearing level for REITs would go up. It's only logical. Well, now you listen to what Shamath Palihapitiya has to say about repricing of these assets and why he's hoarding cash, right? This is from a YouTube video that I found. Okay, so let's have a listen.
I think what happened this week is actually pretty important, because I think the markets were really trying to force Jerome Powell to start the cutting cycle. And now they had to move the date at which they could expect cuts out by a year. And I think that we're only starting to see the reverberations of that. You're going to have to reprice a lot of risk assets. So if you put it all together, oil is creeping back up. So commodity prices essentially are trending up. I don't think that's going to have a big impact on inflation because of the way that owner equivalent rents and core CPI is calculated, because it's calculated on this 6-month lag, this dumb nonsense of just how arcane our system works. But that's going to spike down. So basically the Fed's like saying, we know all of this is happening, we're sitting on our hands. But the problem is that if you add another 100 basis points to your discount rate for an unprofitable SaaS company, my gosh, guys, you're taking like another turn and a half of market cap out of the business. Like if you thought it was worth 8 times, it's now worth 6.5, 6 times. So unfortunately, that's going to hurt everything that's not the top 7 tech companies. And everything else is just going to just kind of meander along for a much longer time. So it's really good for the Magnificent 7. I think it's really bad for everything else. And we're going to be in a holding pattern for a while. I told my CEOs, guys, let's get enough cash to last through the middle of 25. Sure. Remember, I was pretty clear about that to folks. I mean, get to default alive, but if you can't, please have enough money to the mid of 25. I think that was wrong. I think now you got to be Q1 of 26 and maybe even mid 26. So now I have to go back to all these CEOs and redo an entire justification for why they need to cut even more people, cut even more expense, cut more burn. I don't know where we're going to find another year of burn in most of these businesses. So I was wrong by at least a year, Jason, because of this. I think I got the words right, but I got the timing wrong.
Yeah. Well,
Okay, so that's what he had to say. He's a famous venture capitalist in the US. And that's what he had to say. Not for pleasant listening, but he's a very smart guy. Okay, one of the people I would take seriously. And I will leave a link to the YouTube video in the description box below as well, in case you want to watch the entire video, which is about 10 minutes long. So that's just one segment. Like I said, things do not seem to be in a good place right now. And I think it is better to stay pragmatic and not be overly optimistic. Okay, so if AK can talk to himself, so can you. Bye-bye.